I'm Bill Saint, President and CEO of Classica Homes, and I wanted to talk about house price. When we talk about buying a house, the first thing I always talk about is what is the cost? For some reason, when it comes to buying a home, we're the last industry to figure out how to answer this. Because the cost is not the big dollar amount, it's really what are you paying? And what you're paying is some amount down and some amount per month. So think about a car. The car industry figured it out a long time ago that the price for your basic automobile is probably zero down and about $299 a month. But if I want to buy this really cool luxury car, it's going to be $1,500 down and $499 a month. I'm not a car guy, but nobody's going to break your bubble and tell you that that car is really $75,000. Because nobody really spends $75,000. In essence, they're not walking in and truly writing a check for $75,000. The majority of buyers are saying, I've got to put something down and I've got to pay something per month. Well, why don't we do that in the home business? Because when it comes to your home, maybe you're living in a box called an apartment. Apartments do make it real easy and simple. They simply tell you it's $1,800 per month. So now you know your monthly cost. But if you transition out and you've bought your home and you're in a nice home right now, more than likely you didn't give them the big dollar amount. You put something down and you're paying something else per month. This is how we decide what our budget is and what we can afford. So, first of all, what's the cost? This is the cost, the down payment plus the monthly payment. Now, how much do I need to invest every month and how much do I need to invest up front? So let's now talk about, I'm thinking of moving into a luxury home and I want to upgrade. I see this dollar amount, the price of the home, and that's not what I want to look at. What does the beautiful home really cost? Well, let's just say the house is on the market and it's a $600,000 home. Once again, $600,000 isn't the price you're going to pay because you're more than likely going to buy it with a mortgage. So you're interested in what's my upfront price? That's called your down payment. You're also interested in what's my monthly cost going to be? Your monthly payment. Here's the tricky part about it. The math is just too hard for any of us to compute in our heads. I'm a CPA and I can't do it without pulling out my financial calculator. When I ask most people what that house is going to cost, they immediately go to questions and thoughts of, well, it's a jumbo loan, it's an expensive home, I'm probably going to have to put 20% down, so that'd be $120,000, and they guess on the monthly payment. What's reality? Reality is for this same $600,000 home with very good credit, we have lenders that have a relationship with us that recognize our customers have great credit and they love them. So they can get a loan for as little as 5% down with no private mortgage insurance, no PMI, and a very low monthly payment. Today's interest rate for that 5% down mortgage would be somewhere in the range of 3.5%. That equals to a down payment of 5% of $600,000 or $30,000 down. And a monthly payment at a 30-year rate with a 3.5% interest rate would be $2,560 a month for principal and interest. So what looked like an unaffordable purchase turns into a $30,000 upfront investment and roughly $2,560 per month. What's interesting is the next thing. What drives that monthly payment? And I'm going to say what drives the cost, because that's really what you're paying. Remember, the cost is not the $600,000 price. It's the down payment plus the monthly payment to equal that cost. So what drives the cost? Interest rate. I'm going to show you a quick example. Here's a 3.5% mortgage rate on that $600,000 home with 5% down payment. That equals $30,000 down and $2,560 per month. What if rates go up? As more people are thinking now, rates will go up in the near term than down. But let's say they went up 1 full percentage point, and now they're 4.5%. Still a great rate. Love the rate. However, that 4.5% rate would still require $30,000 down for that 5% down payment, but the monthly payment would turn into $2,888 per month. That means I'm spending $328 more Or the difference between the $328 and the $2,560, it's 12.8% more per month. And I still got this exact same home at the exact same price. That means I'm spending $328 more per month, and that equals 12.8% more per month when you look at the $2,560 we used to pay. And I still got the same home, but I just spent 12.8% more. Doesn't make sense. The house here and the house there are both identical. They have the same $600,000 price, but they're not equal because of the payment. That's because the biggest thing that drives cost is the interest rate. When interest rates go up, even by 1 percentage point, your payment always goes up around 12%. So you're buying and paying 12% more, but for no more house. That's why buying today at a lower mortgage rate is so much more attractive than in the future. So the question, what's the cost? The next time somebody asks you, I know you're going to say, it's the down payment and the monthly payment. That's what my real cost for my home is. Simple as that.